When your outgo exceeds your income, your upkeep becomes your downfall. Remember that silver prices lag gold prices. So silver bugs, be patient. Your time is coming.
Please join us for our next live stream Sunday, April 26th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, April 26th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Housekeeping aside, if you are new to this channel or you have not already done so, please do subscribe, click on the bell to be notified of new updates, and give us a thumbs up. If you like what we do, we truly do appreciate your support. Our guest today, a return guest, Rick Rule, President and CEO of Sprott USA Holdings. Rick is also the founder of Sprott Global Resource Investments, and having survived 4 mining downturns and thrived in 4 mining upturns, Rick Rule is one of the best known and most influential people in the resource mining business. And we're delighted that he's back here with us again today. It's time to saddle up and silver up for Rick Rule. Rick, welcome back to SBTV. How are you doing?
It's a pleasure to be back with you. And in answer to your question, I'm doing almost embarrassingly well, given the circumstance that we find ourselves in.
Yeah, it's strange circumstances right now, but I guess, it's for the better, or let's hope it's for the better. Speaking of these things, Rick, it's pretty surreal that this virus just came out of nowhere back in late 2019, and it's knocked the world down on its knees, more or less, and we're seeing borders closed, air travel suspended, communities locked down, and the real economy taking a major hit. Have you had a epiphany of all that has happened within a short period of time, and have you seen something or anything close to this in your lifetime?
Answering many questions, the last first, I have never seen anything like this in my lifetime, and I suspect that most people in developed nations have never seen anything like this in terms of the health challenge in our lifetimes. It should be noted that we have other health challenges that have been with us longer that kill more people and cause more distress. But the impact of this on people's psyches and, of course, on the economy is, at least in my experience, unparalleled. I would note, however, that while we had no way that I know of to prepare for this from a public health standpoint, the fact that our policy responses to other challenges, really on a global basis, for the last 25 or 30 years have been faulty, I think leads people, individual people, and governments and institutions in all systems, in all parts of the world, much more fragile in terms of the policy responses to this crisis than they might otherwise have been. In other words, I suspect that we could have prepared for the economic fallout from this much better in the last 25 years. And I would hasten to add, I guess by way of editorial, that it looks like the policy response to this crisis will be, in effect, throwing kerosene on the fire.
Yeah, I hear you. But what's it like in the area that you live in? What are some of the disruptions that you've encountered in just everyday daily life?
I live in a very nice place, and despite lockdowns, or perhaps because of lockdowns, it continues to be a very nice place. I'm not an epidemiologist, so it's not my place necessarily to criticize the policy response, although I suspect that the policy response might have been a bit more nuanced. I'm 67 years old. And I do have some immunodeficiency challenges. So the idea that I'm shut in is probably a very good idea. The fact that the political response to this in our area has been among other things, to chase surfers out of the water. Young, healthy, vibrant people seems to me to be a little bit excessive. But in truth, I'm not an epidemiologist. The responses that I understand, which is trillions of dollars of quantitative easing. You'll recall in prior interviews, I described quantitative easing as counterfeiting. Among other things, I think is almost felonious. It is disgusting from an American point of view to see all of the stimulus on offer and all of the traditional politically connected hogs wallowing up to the trough to get their unfair share. Silver lining, I guess, on a dark cloud, my suspicion is that the policy response to this crisis will be very good for precious metals investors and later for precious metals equities investors. And I think it's our job to protect our portfolios and our family as best we can, confronted by this collective and collectivist madness.
Yeah, we're definitely gonna get into that shortly. You mentioned it's like adding kerosene onto the fire. Is this crisis the pin that pops this debt-fueled money printing bubble global central banks have been parting with for the last decades?
I don't think. I think there's widespread erroneous belief in the system as it exists around the world. People are desperate for the government to do something. They don't want to take responsibility for their own financial future. And wanting desperately to believe, they will find a way to believe. So I don't think that this is the circumstance that causes a definitive reset, as an example, away from central banking and fiat currencies to a more rational economic system. I think that's asking for too much. I do think that this is a circumstance that will diminish and perhaps severely diminish the living standards of people who come after us. Quantitative easing is a function of debasing the currency. It is an income transfer at once to established political classes, but also to spenders from savers. Debasing the currency simply debases the numerator of your savings. At the same time that artificially low interest rates reduce the compensation that you receive for the risk to your savings. So make no mistake, to the extent that fiscal stimulus and artificially low interest rates solves the current problem, what it does is compound future problems. This is particularly problematic, I suspect, for people of your generation, because one of the things that artificially low interest rates, excessive debt, excessive deficits, all these sort of things do is transfer benefits to my generation, the older generation, and transfer costs to your generation. Defenses for your generation? Well, I think one critical defense is precious metals and a longer term defense, precious metals equities. But I would also, and we'll get into this later, I know, urge that savers of all generations maintain a high degree of liquidity, keep a lot of cash to spend, despite the fact that the purchasing power associated with that cash gets less and less. In the volatility which is certain to occur in the next 12 to 18 months, cash will give you the tool and the courage to take advantage of volatility rather than by being taken advantage of. It's important to note that everybody will be looking to the political leaderships for a policy response to make society anti-fragile. Their response will make society more fragile. It's important that your listeners understand their obligation to make themselves anti-fragile.
Okay, anti-fragile. When it comes to cash, I often hear all the time people saying cash has an expiry date on it. What's your opinion on that? Is there an expiration date on cash?
I think so, but I think it won't occur in my lifetime, which is to say, while I agree with the sentiment, I don't agree with the tactics. In terms of the currency that I operate in mostly, which is US dollars, I understand the fact that the purchasing power of my savings denominated in US dollars is probably declining at 2 or 3 or 4% compounded. That notwithstanding, I have large US dollar cash positions because US dollar cash, is the medium of exchange. And given that it's the medium of exchange, and given that I am still trying to increase my wealth in investment markets, that cash is a tool that can't be overlooked. I understand the strategy with regards to cash over time, but the near term, and I regard the near term as 2 to 3 years, tactically, you absolutely have to have high cash positions.
Okay. And just want to back up a bit on one more thing I heard you say. You mentioned the word reset. In your view, how does the reset look?
I don't know. I've been thinking a lot about that, but the honest answer is I don't know. The thing that keeps me awake at night, although it would be interesting from an intellectual perspective, would be to see a U.S. Treasury auction where nobody came, and they had to buy the whole issue themselves. All bets are off if the government loses control of individual investor confidence or loses control of credit markets. If you were to see a free market develop in interest rates, which I think needs to happen over the long term, if you were to see that happen over the near term, you would see a wave of credit default unlike anything that you have seen since the 1930s. I don't believe that this is going to occur, but that is the reset that really, really scares me. The reset that I hope to see is that your generation, through organizations like International Society for Individual Liberty, Students for Liberty, begin to develop the mindset that you need to take care of yourself, you need to take care of your family, you need to take care of each other in groups, but groups that you communicate with. Let the state take care of itself. To the extent that 7.7 billion people on Earth worked at looking after their own affairs and making themselves anti-fragile, society would take care of itself simply as a consequence of 7.7 billion people becoming stronger and less vulnerable. So the reset that I would like to see isn't so much as at a societal level as an individual level, because if the individuals reset themselves, society is reset automatically.
It's a great point. Great point. Rick, what is undeniable about this? The massive losses from businesses forced to close, travel restrictions, tourism basically evaporating, and I'm not sure if we've even seen the full knock-on impact from all these disruptions yet. In your opinion, what is the single most important thing that nobody is talking about regarding the global economy right now?
The fact that the global economy isn't sufficiently, what would be the correct word? In the fact that there isn't enough savings on a global level to absorb the circumstance that we find ourselves in. What we are having to do with currency debasement and adding debt is that we are stealing from your future to subsidize our presence. Everybody must understand that the function of the state, as it sees itself, is to redistribute wealth. And what is happening, unfortunately, is that the spenders, who are numerous, have declared war on the savers, who are scarce. You don't recapitalize a society by spending. And that means that because we won't do this as a society, we need to do it individually. Now, the truth is that I think in the very near term, the policies that I so viciously attack talking to you are going to work, in the sense that as we begin to develop ways to handle the public health challenge, that the simple increase in liquidity in the system and the citizens' desperate wish to believe in the fallacy of curing a problem of solvency with liquidity I think that you will see calm return to markets. I think you will absolutely see volatility, but I think that the direction that you are going to see is that liquidity flowing through the system will calm some aspects of the storm. There's a famous Wall Street phrase that says, when the ducks quack, feed them. Now, what that really means is that when people are clamoring for access to some asset class, that you manufacture pieces of paper representing that asset class and sell them to them. But in this circumstance, you have 7.7 billion automatons worldwide saying, save me, save me, save me. That's the quack. And the duck food, if you will, is counterfeit specie. And my suspicion is that the ducks will be fed, albeit they'll be fed the savings of their children. And everyone, with the exception of the children, some years from now, will be happy.
Okay. What was that word? Automatons?
Automatons.
Where'd you get that?
You know, one of the benefits of talking to people like this for 45 years is that you learn words and how to use them. I take great delight in the English language.
Okay, I'm gonna have to remember that one. Another word I heard you say, antifragile, antifragility. Have you assessed how this crisis could impact investors and which assets would be the most vulnerable right now?
I suspect in the near term, the most vulnerable companies will be the capital hungry companies. Growth companies that are either pre-revenue, that is potential growth companies, or companies whose business plans involve access to cheap capital, both debt and equity, and perhaps leveraged financial services businesses. My suspicion is in the United States that the leveraged financial services businesses are such good lobbyists that they will be able to wallow up to the federal trough and be force-fed enormous amounts of quantitatively eased liquidity. So I suspect that you're going to see Wall Street and the banking industry and the insurance industry, the hedge fund industry, the money market industry, all of these people sustained in the near term with newly printed liquidity. And while I suspect that there will be long-term consequences, I suspect that the average citizen will feel like he or she has been saved by the big thinkers. I'll leave it there.
Rick, what about the potential adverse impact from already highly indebted countries such as Italy that may knock down the next wave of dominoes in the global economy?
I think that's a real risk. I think that's a real risk. When I use the phrase anti-fragile, your listeners would be well advised to Google Nassim Taleb and read his work, because that's where the concept fragile and anti-fragile in my usage comes from. There are a lot of a lot of fragile institutions worldwide as a consequence of 3 decades of easy money, Italy just being one. Unfortunately for the Italians, and probably fortunately for the rest of the world, the Italians don't have access to a printing press. They need to convince the EU to continue to subsidize their spending habits at the expense of German savers. Americans are much more fortunate. We don't have to spend or save. All we have to do is counterfeit. And there are other circumstances around the world where there are savers where there are spenders, aggregation of spenders, sometimes called companies, sometimes called countries, that don't have the ability that the United States has to counterfeit endlessly. And those will certainly be, in the near term, much more fragile institutions. My suspicion is in Europe, too, that the average citizen wants the big thinkers to get them through this, that the average person in Europe doesn't want to be confronted with an Italian default or a Greek default, or much, much, much worse, a French default. given that savers in Germany don't want to be stolen from in the near term, which would be the alternative, my suspicion is that the European central banks will follow the lead of the American central banks and steal from their children's savings by debasing the euro to keep less competitive countries in the south of Europe solvent. Will they succeed or not is a really interesting question. And I think that really goes to the confidence of the citizenry. Can the big thinkers of the world convince the citizens that liquidity, which is to say cash, is a substitute for solvency? Solvency and liquidity are very different. I was taught a poem as a young man that I'd like to recite for your listeners that goes to this. When your outgo exceeds your income, your upkeep becomes your downfall. A circumstance where we have lived beyond our means as a society, which some societies have done for a very long time, calls into question our continued ability to do that. So to the extent that we finance this crisis, what we do is make the next crisis worse.
How's the gold and silver mining industry doing at this moment? Are mining operations still going on? Have they shut down?
The increase in the gold price in particular has been more beneficial than many of your listeners probably understand. We'll get to the silver miners in a while. But the mining industry, at least the precious metals mining industry, has been somewhat more robust than many people would have suspected. I myself think that the current robustness in the precious metals mining industry, ironically, is a consequence of the fact that they were starved for capital for 8 or 9 years. They had to become efficient, and the fact that debt capital wasn't available meant that many of them didn't borrow too much. The fact that equity was cheap means that managers made fewer mistakes and became more efficient. Now, I think in the equities, we head into a perfect storm in a positive sense. The price that you sell your product for is denominated in a relatively strong currency and is rising, that is the US dollar. But particularly if you are a non-US oriented producer, your currency is falling, which means that your input costs are declining. Increased product prices with decreasing costs are a very good thing. Add on top of that the collapse in oil prices, which has in many cases halved companies' energy costs, and you are set up for a wonderful set of circumstances. Many of your listeners say, well, why hasn't this blessed event occurred? That's fairly easy to discuss. Precious metals prices don't rise as an immediate consequence of a crisis. They rise as a consequence of the policy response to the crisis. That's why you're starting to see the gold price increase now. Remember that silver prices lag gold prices. So silver bugs, be patient. Your time is coming. The metals move before the equities move. It's important that everyone understand that. If you look back over 45 years, what you will see is the metals move, and then a couple of quarters later, as the increase in the metals price is reflected on the income statement and then the balance sheet of the industry, the equities move. So we have what is, from my point of view, almost a positive, perfect storm in the precious metals mining businesses. The mindsets of the managers were reset by 8 or 9 years of scarce capital, which meant that despite their best efforts, they were forced to be rational, forced to be cautious, forced to be intelligent. And I think those lessons will be with them for a little while. I think the scare associated with the coronavirus will help that sense of wonderful paranoia. The policy response to the virus will be, in almost every circumstance, good for precious metals prices. Gold first, silver later. And those increases in metals prices, combined with weakness in the economy and weakness in currencies, which will depress the prices that mining companies have to pay for goods, services, and labor, means that their margins, the spread between the prices that they get for their product and the cost that they have to pay to generate the product, will increase. And as a consequence, the share prices will increase too.
One of our viewers, Mike Tran, he asked a question for us to relay to you. How likely would governments like Mexico, Canada nationalize gold and silver mines in the next global financial crisis?
I think, anything can happen. When you trust a government to do the right thing, you're always setting yourselves up for a mistake. But I think that governments have learned an important lesson. It's easier to steal from citizens and savers by debasing the currency and artificially lowering the interest rate than it is to steal hard assets. 30 years ago, 40 years ago, they would have been forced out of desperation to steal hard assets. But they don't have to steal hard assets anymore. All they have to do is depreciate the net present value of their obligations. It turned out that the author of the modern economic system, the author of modern monetary theory, well, I guess if you go all the way back, the author might have been, Bismarck or somebody in Weimar, Germany. But the more recent financial genius that we have to thank for all this was Gideon Gono, the guy who ran the Zimbabwean central banks. It's odd that the United States would have adopted the financial policies of Zimbabwe, but the truth is that is what's happening, and that worked. The government doesn't have to steal gold and silver mines. All the government has to do is convince savers that for their own good, the government is devaluing the value of their savings. The ultimate theft. And the truth is that the populace adores the thieves.
Why doesn't the Canadian government own any gold in reserves today? I know they had sold it off, right?
For many central bankers, gold represents a vote of non-confidence. Gold doesn't pay interest. Treasuries pay interest. If you own gold in favor of government debt, what you do in your own mind is you devalue central bankers. Why would they like that? Central bankers believe in central banking. Gold is a medium of exchange, to be sure, but it's also a store of value. A negative interest yielding treasury is not a store of value. It's a destroyer of value. Gold represents protection from central bankers. And the idea that central bankers would focus on owning an asset class that was designed to protect people against them would be an acknowledgement of the perniciousness and evil of central banks and governments. So it makes perfect sense that there would be a philosophical aversion on the part of central bankers to precious metals. 6 or 7 years ago, during a period of high real interest rates, there was an argument on their behalf. They could hold as reserves assets that generated a positive yield. In today's environment, however, where both the nominal and in many cases the real yields are negative, that argument doesn't hold water.
Gold and silver. Gold and silver prices took a massive dive in March, and gold has since pretty much recovered pretty strongly, crossing the $1,700 mark per ounce, which is about an 8-year high or so. Silver, on the other hand, it's lagging again and has yet to fully recover like gold. Rick, what's happening with the silver market, and is it true that the price action in silver consistently lags gold, as you were touching on before?
Answer the questions in reverse order. Yes. In every prior precious metals bull market or precious metals recovery, gold, which responds to fear, moves before silver. When gold establishes price momentum, silver, the poor man's gold, moves later, but moves further. Now, the first question, the lag in precious metals prices. It's important to remember, and it's important for your younger listeners to understand, that it isn't fear, it isn't the crisis that increases the gold price. In truth, gold did exactly what it was supposed to do. When credit went out of the system and faith went out of the system, everything that had a bid got sold to reduce leverage because there was no credit in the overnight system. Side note, at Sprott, we were told by counterparty gold banks that as the crisis erupted, there was as much as $60 billion in leveraged long commodity trading accounts wrapped around gold. When the credit came out of the system, those leveraged long positions had to be unwound. And there was a bid. They were able to be unwound. Gold did exactly what it was supposed to do. And when you say that the gold price didn't perform, the gold price didn't perform well in the near term in US dollars. But think about gold priced as against corporate debt, or think about gold priced as against equities. Think about gold priced in currencies other than the US dollar. Gold did extremely well unless you measure it in US dollar terms, in which case it lagged. It's important to note, however, that as we stated earlier, gold doesn't move as a consequence of the crisis. Gold is merely a source of liquidity. Gold moves because of the policy response to the crisis. So let's talk about the probabilities of an increase in the gold price. Gold's, I would argue, principal competitor is US dollar denominated savings, and in particular, US denominated treasury securities. Gold increases in price because investors and savers are concerned about the retention of purchasing power of their savings. And those people, those savers, have reason to be concerned now for three particular reasons. The first is that quantitative easing, or by its more accurate name, counterfeiting, debases the currency, which means that the numerator associated with your savings is being debased, and debased by trillions and trillions of dollars. The second reason to be concerned is debt and deficits. We've talked about this before, and I'm not going to talk about other countries. I'll just pick on my own. But the on-balance sheet liabilities, that is to say that the bond indebtedness, and the off-balance sheet liabilities, which is to say entitlements, at the federal level in the United States exceed $120 trillion. That's before state and local. And we're going to service this debt with the national income, which is taxes and fees less expenses. The problem is that that number will be negative this year to the tune of $2 trillion. In other words, rather than service the debt, we're going to increase it. Your young viewers, and I'm delighted that you have all these young viewers, need to ask themselves if it's possible to add these deficits, that is to say, add a column of negative numbers and come up with a positive sum. Because if you can't add this column of negative numbers, or you can't reduce expenditures, which we don't seem to be able to do, this debt becomes unserviceable, and you need to print increasing amounts of money, debase the currency to make that debt go away. While that debt sits there, what it is a risk to US dollar denominated savers, because remember that this debt has to be serviced. The third challenge that savers need to be concerned about is artificially low interest rates. The interest rate is the reward that you get for taking on the credit risk and for foregoing current consumption for future benefit. And the interest rate now is, in nominal terms, and in some cases in real terms, below zero. Think about it as my friend Jim Grant describes it: return-free risk. The principal competitor that gold faces is return-free risk, and that's not a very hard fight to win. So the circumstances that are in front of us, while they're bad for almost every other aspect of our portfolio and our financial health, are sadly good for gold. Remember one more time that gold doesn't respond to the crisis Gold responds to the policy response to the crisis. Gold responds to investors' faith in the ongoing purchasing power of fiat currency, particularly US dollar denominated savings savings products. And for three reasons: counterfeiting, debt and deficits, and artificially low interest rates. One would expect that these policy responses will be very good for gold, later for silver, and ultimately good for high quality gold and silver stocks.
It's very good info right there, Rick. Thank you for that. You also said in a recent video that silver is hellishly difficult material to do forecasting on. For viewers who may not have watched that video, can you share with us why you said that?
Yes, sadly, I'll make my inadequacies public again. Firstly, it's very difficult to get a handle on supply for silver. The last time I looked, only about 18% of supply that comes on the market annually comes from silver mines. The rest comes as a byproduct of copper mines, gold mines, lead mines, zinc mines, and of course, scrap. So to forecast silver supplies, you have to forecast mining activity in all these other commodities. In other words, you have to have a good sense of where the copper market's going to be, as an example. The other part of silver supply that's very tough to understand is an enormous amount of silver is held as private savings in South Asia. India, Pakistan, Bangladesh, Sri Lanka. And those people have thousands of years' experience with their own government. So they're highly unlikely to report those savings for fear that they'll be stolen. Whether or not this private hoard gets added to or subtracted from has to do with things that are internal, as an example, to the Indian economy. In a very good harvest where rural incomes in India are high, enormous amounts of physical silver disappear into rural India in the form of savings. In circumstances where the rupiah gets whacked and where the harvests are bad, enormous amounts of silver get sold to feed families. So the supply of above ground stocks becomes very, very difficult to forecast too. On the demand side, while investment demand is extremely important, it isn't merely Western demand. It isn't merely reportable demand in the United States and Canada and Western Europe. Increasingly, East Asian and South Asian institutional and retail demand are important. And then you have to consider industrial demand. In industrial demand, you only used to have to look at photography. Interestingly, photography has gone away. I mean, it's gone to silver heaven. So now you have to look at things like the rate of absorption of solar power, because solar panels are a huge, huge, huge source of demand for silver. Silver is increasingly important as a germicide and important in water and sewage treatment. It's extremely efficient. But the consequence of the myriad of uses and the secrecy of some of the users, which is to say savers in South Asia, makes demand forecasting difficult. At the same time that supply forecasting is difficult, also because of the intention of users and savers in South Asia, and as a consequence of the fact that silver mines don't produce very much as a percentage of the silver supply. So I hope that answered the question.
Yeah, no, absolutely. What do you make of the situation in the physical gold and silver market right now, where dealers buy bullion much higher than spot price and resell at even higher premiums?
I've never seen a circumstance in my life where the dealer community was forced to pay premiums to spot for retail product. This is highly, highly unusual. And I guess it's a consequence of three factors. One has been that the dealers themselves have seen their own credit lines contract as there's a lack of trust across all financial services institutions. So a wholesale dealer that might have had a $200 million credit line suddenly sees himself or herself with a $20 or $30 million credit line. So they're constrained in terms of their inventory. The second is that there is very broad, very deep, and very vigorous retail demand for silver and gold, physical gold and silver. At we are able to buy some days $50 or $60 million worth of bullion a day. There is not the same shortage in institutional product, in 400-ounce gold bars, as an example. Although there are some regional shortages of those bars, we have been able to accommodate inflows into our physical products on the market. And you'll recall, we aren't in the Sprott products allowed to take deposit receipts. In other words, we can only hold physical metal. We have been able to buy that metal, but we're not buying it in 1 ounce and 3 ounce and 10 ounce lots. Retail products are effectively sold out. The third problem that faces the retail market has been that the COVID virus has shut down refiners and mints. And the consequence of that is that the ability to buy 400-ounce bars and refabricate them into 1 ounce product in the near term is gone. But we understand that the Swiss refiners, who are particularly important in this process, will at least hope to restart fabrication in as little as 2 weeks. And the Royal Canadian Mint, we understand it, intends to restart limited production next week. It's important to note that the Royal Canadian Mint, however, because of their technology and their market, will be focusing on LBMA, CME, good delivery, 400-ounce products. And so the Royal Canadian Mint will be unlikely to assist in lowering the premiums that you see in physical product.
Another question from our viewer, Mayam and Abstract Fitness, asked, what would be your exit strategy with regards to gold and silver, and also gold and silver equities? And what are some signs that investors should look out for, telling them it's time to liquidate metals?
I personally, as a saver, will never be without gold in my portfolio because I regard it as insurance. There will likely be a time 2 or 3 years from now when I hold less gold than I have now because other investment classes will appear to me to be more attractive. But the truth is that what gold does for me is it allows me to sleep nights and stay calm. And at age 67, I like to sleep. So I will never be without it. But when it becomes popular, and I don't know what price that will be, but when it becomes popular, I will have less rather than more. Most investors operate completely differently. For most investors, the price action justifies the narrative. So as the price goes up, they buy more and more and more. That's not the way I personally operate. I will doubtless, probably fairly quickly in the next 2-3 months, add to my holdings of physical silver, but not from an insurance point of view, but rather from an investment or speculative point of view. My experience has been that moves in the gold market trigger the silver market. And despite my sage advice, I'm as greedy as anybody else, and I'd like to pay attention to this. The real moves that you will see will incur in investment and speculative markets, which is to say, first in the high quality gold equities, then in the later in the rest of the gold equities, and finally in the silver equities. When you see me on media products like Fast Money, that is when I move away from being a cult figure among doomsday audiences like yours and mine, to being featured on mainstream media in 2-minute sound bites for traders, you will know that it's time to liquidate some of your precious metals and most of your precious metal stocks. My suspicion is that that time is at least 1.5 years or 2 years away. For illustration, and I will happily send this to your viewers, I refer to the Barron's Gold Mining Stock Index, the BGMI. I refer to that because it's a broad index, and it's an index that goes back 45 or 50 years. I'm not a technical analyst, and I refer to this chart merely as an educational tool. But it teaches us a lot that goes to your viewer's question. Over the last 45 years, what you can see by looking at the relative valuations of gold mining equities is that the the weak period that we've just been through, the 7, 8, 9 year bear market that we've been through, in terms of historical norms, is very, very, very long. We went through both a steep and a long decline. And the chart shows us, I think, that we are approaching the bottom, at the bottom, or much more likely off the bottom of what was a very deep and very long market. The second thing that the chart shows us is that there were 8 prior recoveries from oversold bottoms. Those recoveries could be as short as, I think it is 13 months, or as long as 42 months. The recoveries have varied, and this is for the whole index, not individual outperforming stocks. The index itself has risen between, I think the number is 180% and 1,200%. That chart teaches us that we are, as I say, to recap, at the end of a bear market or off the bottom of a bear market, into a bull market, and the recovery in terms of the index that one would see in that market is pretty astonishing. I would tell most of your viewers, particularly the ones who are younger and newer to precious metals markets, that early in a bull market, the companies that do the best are the highest quality companies in the sector. They aren't the penny dreadfuls. The biggest and the best. First, because existing precious metals investors have had a very bad experience for 8 years and they're risk averse. They want to be in the space, but they want to be in the best of the best. And secondly, because when the generalist investors come into the precious metal spaces, they don't have the sophistication to go into the rest. They need the big, big, big liquid names. It's important, too, to recognize that in a market where the market as a whole generates 180% to 1,200% gains, you don't need to outperform a market that has that much data. You just need to avoid mistakes. Yeah. So construct precious metals portfolios by owning the metal first and then the best of the best. There is time to come to take more risk and diversify your portfolio down the quality trail.
Okay. Couple more questions. Martin Choi, he wanted to know if you're in favor of a gold standard.
Yes, intellectually, I'm in favor of a gold standard. It will never happen as long as there is democracy in the world. The political class, first of all, looks at the gold standard as a constraint on their power. And for politicians, the currency that they live for is power. The idea that they would agree to a circumstance that limited their ability to counterfeit the currency or favor political constituencies is a non-starter. Sadly, too, in democracies, democracies feature as one of their core components a war between spenders and savers. Spenders are numerous and savers are scarce. There's a wonderful libertarian lapel pin that says democracy is the process by which 4 coyotes, predators for those of you in other countries, and a lamb vote on the lunch menu. For most people in the world who would like to live rich as opposed to be rich, a gold standard limits the political class's ability to steal from other people and deliver to them, and so is, in fact, politically unpalatable. Would I personally like to see a circumstance where my medium of exchange was a store of value, where there was the sort of price stability that comes from not being able to pervert the currency? Yes. But other than in some sort of anarcho-capitalist fantasy, which I harbor frequently, I can't see that occurring.
Yeah, okay. And Desmond Cahill, he asked if you could explain the Sprott allocated gold and silver trust, and can we trust the Royal Canadian Mint in a total depression?
In reverse order of questions, again, I believe that governments have learned that it's easier to steal with artificially low interest rates and quantitative easing. I don't think that the Royal Canadian Mint has any fear of the Canadian government coming and stealing the gold and silver in the Royal Canadian Mint. The Mint itself, although I don't like government institutions, I found as a customer is fairly well run. It's debt-free. It generates a profit to the Canadian Treasury. We are, I believe, the largest private tenant of the Royal Canadian Mint. And I have to say, despite the fact that I hate government organizations, that it's a fairly well-run organization. As to the structure of our trusts, it's important to note that virtually all of the assets in our trust, save a small cash component to pay expenses like our rent at the Royal Canadian Mint, is physical gold and silver. We don't have daily inflows or outflows in those products. Our inflows and outflows are periodic. And the consequence of that is that virtually every dollar invested in our trusts is reinvested immediately in physical gold and silver. That's important because in a really, really bad liquidity scare, the ETFs, which have much more dramatic inflows and outflows on a daily basis, might find themselves as unsecured creditors to counterparties that had delivery receipts or deposit receipts as opposed to physical metal with those trusts. The second advantage that I would say that the Sprott trusts have, aside from metal backing, is that for U.S. investors, capital gains, if any, are taxed at the capital gains rate, while physical precious metals ownership or the ETFs, which are regarded as surrogates for physical precious metals, are taxed at the collectibles rate. If you are a taxpayer in a high tax state like California or New York, the tax savings owning the Sprott products relative to the ETFs or physical product itself can be quite substantial.
Okay. Rick, before we wrap up, and I know we touched on this a bit, but before we wrap up, can you let our viewers know more about Sprott Global and how they can benefit from its services?
Well, what I'd like to do is give your listeners the ability to test our services at no cost to themselves and with a benefit. Specifically, and I've done this on your show before, I would like to offer any of your listeners, any of your viewers, the opportunity to email me personally. The email address is rankings, rankings, @sprottglobal.com. If in the text of the email, not as an attachment, your viewers will list all of their natural resource equities holdings. By the way, just natural resources, not supermarkets or banks or technology companies, just things I understand. I will email them back my rankings of their companies, 1 to 10, 1 being best, 10 being worst. And I will comment on those individual issues where I think that my comments might have value. As a bonus, I will include the Barron's Gold Mining Index chart that I referred to in this discussion, which is a wonderful illustration of where the gold mining industry has been and where it might go in the future. And finally, I will include a 100-year chart of the commodities complex, the value and price of commodities relative to other classes of financial assets. You can obtain this, as I say, by emailing me personally at rankings, rankings. It's important that you have the names and the symbols in the body of the email, not as an attachment that an old 67-year-old Luddite can't open, even if his computer security would allow him to. And I will answer each of these personally. Once we've done that, once we've established the relationship that comes from me viewing portfolios and giving your subscribers value before I ask anything of them, then we can have a discussion on an individual basis about which Sprott goods and services are appropriate to your viewers. Certainly, they need to know that at Sprott, we manage over $12 billion in assets. And we don't focus on every asset in the world. The assets that we manage are precious metals and natural resources almost exclusively. There are 180 of us with many disciplines, geology, engineering, financial analysis, portfolio management, worldwide, waiting to go to work for you. But in order to establish how we can benefit you most directly, I think a wonderful way to start would be simply us reviewing on a no obligations basis everybody's natural resource and precious metals portfolio.
Okay, excellent. We appreciate that offer, Rick. But before we head out, is there anything else you would like viewers to know?
Yeah, everything that we say here is speculative. I think it's important to know that. Warren Buffett famously said that predictions tell you lots about the predictor and very little about the future. There is nothing that we've said here that is 100% absolutely positively guaranteed to occur. I think if you look at the factors at play in the market today, the probabilities are that many asset classes, particularly savings, will suffer. And certain asset classes, physical precious metals and later precious metals equities, will benefit. That does not mean that it's efficacious for anybody to take out a second mortgage on their house and put 100% of their assets in penny dreadful precious metal stocks. What you need to do is act prudently, become antifragile yourself, and act on probabilities, because really there are no certainties.
Okay, Rick Rule, we thank you for the time you've given us and all that you've said and the direction that you pointed us in, and we'll be sure to point our viewers in your direction.
A pleasure. We should do this more frequently. I enjoy it.
Okay, we just might. Okay, Rick Rule, we thank you for your time, and we wish you all the best.
Thank you for your platform.
That was Rick Rule, President and CEO of Sprott USA Holdings, sharing with us his invaluable insights and the opportunities in the gold and resource industry. To find out more about Sprott Global, please visit the website sprottusa.com. If you like this video, hit the like button. Please do subscribe and check out the SBTV podcast on iTunes and Spotify.